Hello students, with this session we are covering heart of auditing standards. This is a heart and there is definitely questions are expected on this element. Risk based audit. So we are going to cover many standards and we are going to discuss a skeleton, an approach, how you should approach for many of the questions because the base remains same, which is nothing but SA 315 and 330, risk based auditing. So let's understand what talks about SA 315, 330 and how the same thing is applied in many other standards. Okay, so basic, for example, if you are doing audit of any area, so generally students make error is they start with main audit procedures directly, which is about test of detail vouching verification. For example, if I ask you how you will do audit of bank balances, then many people will say we'll check bank reconciliation statement, we'll check supporting documents, etc., etc. But there is a logical flow which is being defined in SA 315, 330. Now what's SA 315 says? SA 315 says identification and assessment of risk of material misstatement through understanding entity and environment. That is understanding. And then SA 330 says responses to assess risk. Means 315 says jo bhi whatever risk you have identified, how you will respond to that, that is 330. So 330 is always further audit procedures. So for any question, first is understanding element and second element is responding to what you have understood. So the output of understanding is always a risk. So that risk might be inherent risk or control risk. So what do you mean by inherent risk? Inherent risk means those functions, those processes where you believe there is no internal control system. And when I say control risk means you believe there are controls, but those controls are not really effective enough or they are weak. So if your inherent risk and control risk IRCR is high, then obviously your audit risk is high, right? Then how you will reduce audit risk? By reducing detection risk. And to reduce detection risk, the steps followed is you will decide what should be the audit procedures, what should be the sample size, whether you need to use experienced staff, whether you need to use experts. So that is your responses. Okay, so 315, identification and assessment of risk of material misstatement. How you will identify? For identifying, you have to perform basic inquiry level audit procedures. So what is that? One is inquiry with management, inquiry with TCWG, inquiry with employees. That is understanding of that existing process. Then you will do analytical procedures, that is comparison with previous year, comparison with budgets, etc. The analytical procedures, ratio analysis, etc. You will have observation, understand business operations. You also inspect key documents to get a global idea of your systems. Like you inspect SOPs, standard operating procedures followed, what are the accounting policies followed, what are the applicable financial reporting framework, nature of industry. That is mainly covers understanding internal control system. And when I say internal control system, means your system should achieve at least 4 objectives. Whether your internal control takes care of financial reporting reliability, whether your internal controls takes care that you are complying with laws and regulation, whether your internal control takes care that your functions are operating effectively, your assets have been safeguarded or not. And for that, your internal control should be exhaustive enough. Now, what that should be exhaustive? So the SA 315 says your internal control should have 5 components. Now, one of the important component is control environment, that is governance, that is policies, HR policies, governing bodies involvement in day-to-day operations or whenever there are high-risk areas, HR policies level. So that is on an organization level, control environment, which is generally known as a base for strong controls. Because the tone of top management decides how operational or line item, line staff works, right? So it is always like, hamara boss itna acha hai and all stuff. Second, entities risk assessment procedure. See here, when I say internal control, it's a management responsibility. The auditor's role is only understanding this. So entities risk assessment procedure is whether entity has their own risk assessment system or not, whether they regularly review internal controls or not. For example, whether they identify risk. So there are business risk, there are compliance risk, there are competitors risk, there are financial risks, there are environmental risks, there are so many risks associated. So whether they are knowing that risk, whether they have recorded those risks, and whether they have seen what is likelihood of occurrence of that risk and what are the mitigation plans. So misstatement, if something happens, then I would say it is a risk. Why that misstatement has happened, or why that misstatement has not identified by the organization. So whenever auditor identifies misstatement, his first step is not to correct that misstatement, is to identify reason why entity system failed to that identify that particular misstatement. So that is again a weakness of internal control system. So first component, control environment. Second component, entities risk assessment procedure. Third component is of control activities. Now that is a typical which you must have done is internal check system, maker, checker, segregation of function. The person who has custody should not be accounting for that, rotation of duties, policies at operational level. That all activities how should be controlled. So those are control activities. So these are three basic components: control environment, risk assessment procedure, control activities. Fourth one is information system and communication. So that information system might be manual, might be ERP oriented. If it is ERP oriented, then auditor should understand how your internal controls designed to capture conditions, transactions, events, how they are translated to general ledger, how financial statements are prepared, because we are concerned with those information systems which affect your preparation of financial statements. So ERP, what are the manual controls, what are application level controls, what are controls at operational level, all those stuff you understand in a information system and communication. And last, very important, is monitoring control. That is component of internal control, monitoring. You have good control environment, you are having excellent risk assessment procedure, you have amazing information system, you have good control activities, but these are designed well, these are implemented well, but are they maintained? So for that you need to monitor. Now how monitoring happens is involvement of governing body, involvement of senior management, or the best thing is involvement of internal auditor, because internal auditor reassures you whether your internal controls are operating effectively or not. So these five components you have to understand. Wherever you identify weakness, you will say control risk. Wherever you will find there is no controls, you will say inherent risk. And based on that, you will decide your responses. Now let's go to 330, how you will respond. So step 1 is assessment of risk. Responses, one is macro level, which we call overall response. So if you identify some areas which are highly complicated, for example, forward contract transaction or complex financial instrument transactions, where there are many complexities involved, then obviously you will not use your junior staff. So your overall response is use experienced staff. Increase supervision at partner level. Expect uncertainties if the risk is high. You might have to change nature, timing, extent of audit procedures on time to time. So that is how you will have an overall response. Then your third step is control testing. Say for example, you have understood system of procurement at basic level from management inquiry, from questionnaire. But test of control is selecting few samples and actually testing those controls. Actually testing those controls with some sample whether those controls are in fact in place or not. That is test of control, whether controls are operating effectively or not. And based on this result, you will decide test of detail. That is substantive procedures. That is what you term vouching verification. So how much in detail we should go is result of 3 steps. Risk assessment procedures, second one is your overall response, and third one is your control testing. So this will give you and guide us how to go about it. Okay. So the idea remains same. First understand and respond. Now this same has been used in various standards. So for example, let's take example SA 250, which talks about consideration of laws and regulations. I am covering overall basic stuff so that you have idea of that standard, which help you guys to understand it better. So understand. So now how you will understand laws and regulation? Don't start with non-compliance. Typical mistake. So first, understand from management TCWG, what is your structure to ensure that you are compliant, fully compliant? Do you have a specific identified legal department? Whether they have prepared checklist, whether they have identified different personnel who are responsible for each compliance. For example, for factory relevant compliance, Mr. X is there. Finance relevant CFO is there. HR relevant for somebody else is there. They are reporting on a regular basis. How you get updated with new changes. So what is your system? And you cannot check each and every laws and regulation. Do you obtain from them a W or written representation that all the non-compliances you are reporting to us? That is first understanding. Then second, what you do, you divide your laws and regulations in two parts. That is one, those laws and regulations which have direct effect on determination of financial statement, that is FRF I would say, and those which are not directly relevant to financial statement, directly affecting financial statement, but they are fundamental. For example, Factories Act, if you don't follow, you might lose your factory license. So for those laws which have direct reporting, direct effect on financial statement, you have to obtain sufficient and appropriate audit evidence. That is, you have to perform in-depth audit procedures, which is risk assessment procedure, overall response, control testing, test of details. But for other laws and regulations, you have to perform limited procedure. MCQs, okay, this is very important for MCQs, that you don't obtain sufficient and appropriate audit evidence for those laws which do not have direct effect on determination of transaction account balance disclosures. Okay. Then when you identify non-compliance, what you should do? Many people say you should report. No. First, understand circumstances under which that non-compliance has happened. Why that non-compliance has happened? Is there other possibility of non-compliances? And the most important thing with our objective, how it affects my financial statement. If it affects in financial terms, whether provision has been made. If it affects going concern, then how financial statements are prepared, and then express opinion. Now you also report regulatories. If there is a regulatory requirement to report non-compliances, you will report. Otherwise, you will report only to your addressee. So this is essay 250. Again, we had one part understanding, one part responses. Second, essay 240. What is understanding? Understand from management what culture they have to ensure there is no fraud. What internal controls are there, whistleblower mechanism is there or not. So primary responsibilities of management to have effective controls that there is no fraud. Auditor's responsibility remains same to obtain reasonable assurance that financial statements are free from material misstatement. So what would be auditor's responses? Is one, he should have an attitude of professional skepticism. He should be alert throughout the audit procedures. He should identify those areas where this fraud risk factor is high. Example, high cash transactions, or transactions which are out of normal course of business, transactions which are processed by those people who have direct interest with those parties, related party transactions. These are also meant for some kind of fraud risk factor. So auditor's response would be accordingly to those areas. Some analytical procedures he has performed where results of analytical procedures are deviating from industry. Then again he has to focus on that part. Unusual transactions are there. So he will respond to that, and fraud identified, he will report. Now reporting is again, if it is a company, you have to report under section 143(12) to central government if that value is beyond 1 crore. If not beyond 1 crore, then you report to board and audit committee, and that reporting happens to ADT4 upon HR. Again, apart from that, you are also supposed to report in CARO. There is para 310 where you have to report nature of fraud. So that is 240. Again, understand and respond other standards. SA 501, a typical 315-330 standard. SA 501 is on 3 elements. One is inventory, one is on pending litigation, and one is on segment reporting. Let's talk about inventory. SA 315, understand from management what systems they have implemented to verify inventory. How they ensure inventory exists and what is condition of inventory. What is periodicity of verification of inventory? Whether they have identified any differences, how they are treating those differences. We will not check, we will just inquire, we will understand from them. Yes, basic documents you can validate. Now auditor's response, based on this understanding, he will have gut feeling whether in fact systems are in place or not. Like they have inventory verification calendar for a year. Then my confidence level could be high. Now what I will do test count. Generally at year end whenever there is physical verification, that time I will do test count. I will see my results with management results. If they are deviating, means I have integrity issues with them because they have given me wrong information about their verification, which is in fact not done. So high risk, it means risk is very high. Then I may increase my sample size. Ultimately, I have to see whatever physical stock is there, whether it is been reconciled with books of accounts or not. At times it might happen inventory lying with third party, then whether confirmation is obtained. If feasible, then whether physical verification at that location is possible or not. Whatever results you have to report. Then again, understood you first from management, you responded. Litigation, whether there are any existence of litigation. Now again 315, understand from management what is system to identify litigation. How many litigations they have identified. Inquire them. Give us list of litigations which are in place. and we want to know what is results of that, possible results of that, probability of that. AS29 you have to see because there would be implications on provision. Now, who is the right person to inquire? One is management and legal counsel who is dealing with that litigation. And again, you have to take WR from management that all the litigations have been disclosed to us. Now, this is we have understood. Now, possibility is management may allow, may not allow to discuss with legal counsel. If they allow, then from legal counsel understand what is impact. If they say that there is chances that we are going to lose this case, then you'll ask, okay, what is possible liability? He say XYZ amount, then you will see whether that much provision has been made or not. If not, then you will see that is as a misstatement. Okay. But if management don't respond, if legal counsel don't respond, means risk of misstatement is very high because they are hiding something stuff. Then in this case, you have to perform alternate audit procedure. You might have a legal consultant, legal expert. Okay, and then consider effect on your opinion. Again, we understood first and then we responded. 315, 330. Segment reporting, again SA 501. What you will understand from management, how they identify segment, what procedures they follow to identify segment, whether their systems have flagging option for segment, whether the system only gives data of various segments like business segment, geographical segment, and then take a writing whatever list of segments they have identified. Now your response, you will also identify segment by performing analytical procedures. Very important. If you identified an additional segment, then our question why management has failed to identify that segment, why that segment is not been reported. So what control failed over there, and then you will request them to identify that segment, disclose that segment, and later on you will report if they refuse to report that particular segment. Okay, that is 501, again 315, 330. Next we have again on that 540, again very important standard, auditing accounting estimates including fair value accounting estimate. Now what is understanding? 315, understand from management what are the areas where estimates are required, what FRF requirements are there as far as estimate. For example, in case of banking industry, there is FRF for NPA provisioning. So understand FRF, understand what estimates are there, how management make estimate, whether they use expert, whether they use typical technical support for that particular estimates, whether those estimates are consistent with previous year estimate, whether there are any changes in the method. You also see previous year estimates with actual result, but not to validate previous year's figure, but to get learning for current year estimate. So this is understanding. Now what is my response? My response is wherever I found estimation uncertainty is high. Now what is estimation uncertainty? I ask question, these are your estimate, what you expect actuals, how there will be variation. So they say it will be between 1 to 5%. And previous year, 2-3 years you are saying yes, variation between 1 to 5%. So I will say estimation uncertainty is very low. So risk is very low. But if they have new estimates and they say that we don't know actual how much would be there, means estimation uncertainty is very high, means risk of misstatement is very high. Now their auditor will have his own estimate. So he will use his own expert if required, and he might have his own range of estimate. And if management estimate sets between that, he will say okay, reasonably fine. So where estimation uncertainty is high, you have to perform extensive procedures. Okay. So here you will test methods used by management, whether they are reasonable, appropriate or not. So you will not know technically stuff, right? But again, you have to use SS620 here, that is using work of an expert. And based on that, you will perform further audit procedures. Again, risky stuff is management bias. Now, whenever there are changes in methods of estimate without any reason, without any supporting, they say no, we thought this time 15% is correct, but what is reason behind that? Not given. Possible management bias, high risk, or arbitrarily they have changed, or the changes are not as per industry standard. Okay, ultimately whatever estimates have been made, you have to see whether they are properly disclosed or not, and whether they are reasonable. Don't use the word with estimate whether they are correct. You have to use the word whether they are reasonable or not. That is 540. 550 again in short, related party transaction. 550, 550 related parties. Again, first understand from management what are the related parties, how you identify related parties, what related parties you have identified, give us WR list of those related parties. Okay, then you will identify related party. How you will identify? Exam question has been already asked. You go through investment register, you go to shareholding pattern, you go to various returns filed with ROC, you go to returns filed with income tax authorities, other authorities. From that you identify whether there are any related parties or not. Now, very important, if you have identified, management has provided you list of related parties, Ramesh, Suresh, Jayesh, but you have identified Mahesh also, which is also related party, which is not disclosed. Very, very risky. Undisclosed related parties. SA 550 says immediately you disclose that related party relationship to all the audit team members, including other auditors, and tell them that the materiality level should be 0. Everything is material now, because these are undisclosed related party, and ask management why you have not identified that, which control failed to identify that, because fraud risk factor would be very high, and then ask them to disclose that. If they disclose, fine; not disclose, report particular part. So SA 550 goes into 3 things: identification of related party. Now, definition of related party is what is defined in FRF. If not, then like accounting standard. Second, what are the related party transactions? And third one, related fraud risk factor. So you first understood, then you perform audit procedures. 560, subsequent events. Now, subsequent event, again, there are 2 types of subsequent event. One, those subsequent events which are identified, it is events occurring after balance sheet date, which identified by auditor till date of audit report. So here auditor will request them to make correction, identify that, report that, and if they fail to report, then auditor should report. Now, how sir 315, 330 is applicable? Again, in case of subsequent event, my first question to management: how you identify events which requires either adjustment in financial statement or disclosure? What systems you have? Do you give a circular to all the process owners whether they have entered into any transaction where there is a requirement of disclosure or adjustment? What system you have? Then auditor himself will identify. How auditor will identify? He will see all the transactions post balance sheet date till date of audit report, whether any transaction require adjustment or disclosure in reported financial statement. Now, if auditor identifies, like identification nature ke, one transaction minutes book you can go through, board minutes book, you can see important transactions entered, like some commitments have been given, contracts major are there. So if auditor identifies an event which management has failed to identify, again our main simple question: why you have failed to identify that? What system failed? Is it deliberate failure? Misstatement risk is very high. And then ask management to identify that, disclose that. If they disclose, it's fine. If no, then you will report. Extra 560, there are reporting responsibilities. I am covering only 315, 330 relevant framework. Okay, I am not covering entire standard, but this is very critical for approaching those type of questions. SA 570, going concern. Now, how it is related to 315, 330? Again, 315, understand, management is primarily responsible to assess whether entity is going concern or not. They are supposed to decide whether to close the operations or to continue operation or not. What is auditor's role? Is to identify circumstances or identify situations, conditions which cast doubt on appropriateness of going concern. So auditor should obtain sufficient and appropriate audit evidence whether going concern assumption used by management is appropriate or not. So he will inquire management. He will see whether there are any exceptional items or exceptional stuff has happened, whether there are indicators like key management have left, or competitor has come, your product become obsolete, there is a ban by government, multiple indicators are there. Remember, indicators does not mean company is not a going concern. So when there are indicator, auditor will inquire whether you have mitigator. So if there are indicator and mitigator, then entity is going concern. Might be in loss, but a going concern. But there is no mitigator means entity is not a going concern. So what auditor will do? When there are no mitigator means he will conclude entity is not a going concern. So he will ask management, boss, how you have prepared financial statement? It should be prepared otherwise than on going concern basis, that is at NRV. If they are prepared like that, auditor will say yes, financial statements are true and fair. But he will draw attention of the users through UM panel. But if suppose management refuse to prepare financials at other than going concern. They prepared at going concern. Then auditor has only one option to give an adverse opinion. Okay, but there are some circumstances which only cast doubt on going concern, but it is not confirmed. So these circumstances has to be separately reported as material uncertainties. Okay, that is 570. So these are all the standards, and even any question comes on particular transaction, remember your first part of answer is understanding of controls, understanding of system, understanding of what management is doing, and then start your answer for your responses. Okay, all the best.